Thank you very much for being here. Please excuse the fact that I will give a presentation in English. I am studying Russian, but it's not good enough to do so at this stage. Brief introduction about myself. I'm claims manager, treaty side in SCOR. My responsibility is Russia, Middle East and Africa. I've worked in insurance for 24 years. 10 years of those I was a loss adjuster like most of you here. So I was out there in the field doing the work that you're doing. Then I joined basically what was the Lloyd's Claims Office in London. I became a managing agent, and from then worked in one of the Lloyd's syndicates, and 3 years ago I joined SCOR. Now, as I'm here to talk to you about catastrophe loss management from the reinsurance perspective, and to tell you how the impact of such an event is viewed by insurers and reinsurers. There we go. A brief summary of what I'm going to be talking about. I'm going to go through the catastrophe risk transfer and loss payments, and talk to you a little bit about reinsurance contracts. As we're in Russia, we'll have a look at the Russian disaster risk profile. Then also I'll talk about reinsurance actions when a catastrophe event actually takes place, how we estimate reserves, how reinsurance actually handle claims, which is slightly different to how you would do it as a direct insurer. And I've got two catastrophe examples which I worked on in SCOR, which match the disaster risk profile for all of Russia. And then at the end, if we have time, we can have some questions. As we know, catastrophe events, simple definition up there. Natural catastrophe can be something like storm, flood, earthquake, volcanic eruption. All these cause a great deal of physical damage and triggers, of course, lots of negative effects. Production facilities can be damaged, transport infrastructure is broken, there's widespread business interruption. All this produces direct and indirect losses which have an enormous economic impact. Added to this, we mustn't forget the human element, the suffering caused by a natural disaster and the subsequent long-term socio-economic consequences. As regards insurance, a NatCat will impact aggregate covers, particularly on the points of the duration of the event and the actual geographic extent. Having been a loss adjuster myself, and I've worked in catastrophe operations, following hurricanes, I did an earthquake as well, and an ice storm, I know exactly how an adjuster in the field looks at an event. You concentrate on the assignment of the claims. The main focus is dealing with the individual policyholder. They can be homeowners, commercial property owners, owners of large industrial complexes. As an adjuster, you deal with the large losses, which include hotel chains, industrial engineering, power generation risks. Your main efforts will focus on dealing with the claim. You help the policyholder. After all, you're the representative of the insurance company face-to-face with the policyholder. Basically, the insurance company has sent you as the adjuster to help them. Your advice on mitigation of loss is very important to them because they are trying to get their business back in operation as quickly as possible. Your task is also to inform insurers of what the quantum of loss is, and it's very important that the actual quantum calculation that you recommend is as accurate as possible, because that allows insurers to make a financial record on their books of what their exposure is going to be. You also need to negotiate the settlement of the claim as per the policy, and once it's agreed, it's passed that to insurers, and you expect them to pay and settle the loss, and hopefully your fees too. For a direct insurer, a catastrophe is really a true test of their ability to provide the level of service the customers expect, and they often desperately need. The insurer must meet the challenges of an exceptional high volume of claims. There's wide range of damages. You've got insureds which are dazed and suffering from the shock of the event, and they need help. You've got disrupted communications, damaged infrastructure. All this is what insurers have to face. Also, they have to maintain regulatory compliance and also cost-effective control of the use of their resources. So you can imagine thousands of catastrophe claims as a result of one event introduced necessary changes within the loss adjusting itself. Normally you have a claim, you have it well documented, you've got estimates, you've got all the adjustment calculations. However, in a catastrophe event, given the volume of losses you're dealing with, that's not possible. So the actual catastrophe operation has a simplified form. Usually insurers call it a CAT plan, and that means they've got service agreements with adjusters which allow them to deal with the losses quickly. So you have simplified reports, which can be 1 page, 2 pages long. You have forms of acceptance, perhaps just 1 or 2 photographs of the loss, and that's it. And thanks to technology nowadays, the report, once it's ready, can be submitted electronically, which speeds up the whole process of the actual payment of the loss. talk about the actual risk transfer. Now, of course, the principle of insurance is transfer of risk from the original policyholder all the way up to the ultimate bearer of the risk. Along the way, you've got many contracts and premiums which are exchanged for the protection that's required. Ultimately, you have reinsurers who retain the risks on their balance sheets, but they also share some of it with other participants in the financial markets. If we start with the impact of the event, we can notice that the losses from the insured property and the infrastructure hit the primary insurers first, which you can see in the design up there. These insurers usually rely on their reinsurers to absorb the financial impact of these peak risks. These, what we call peak risk, is a high impact loss event with a high value but low probability. So the financial burden is passed this way to reinsurers, and they, in their turn, use their balance sheets and retrocession or securitization to manage these risks over a period of time. To clarify the terms, retrocession is when a reinsurer buys insurance protection from another entity, usually another reinsurer. And the term securitization is when the insurer transfers the risk-related liabilities to financial markets. You will see them at the bottom of the slide, the other financial markets. I'll explain in detail later. So the risk transfer actually creates a global link within the insurance industry as well between the financial markets. In effect, as a loss adjuster, you can be dealing with the claim out wherever it is the event has happened. It can be South Africa, the Middle East, Thailand, Mexico, anywhere. And you will send your report to the local insurer. You may think that that's as far as the report will go. You're actually wrong, because of course that report, chances are, will find its way halfway across the globe onto the desk of a claims manager in a reinsurance company. So over the last few decades, there's been an increase in natural catastrophes, which have resulted in important financial losses. This is mainly due to an increase in weather-related events, but also there's the rising wealth and the increase in population concentration in dangerous zones. The financial impact of a catastrophe event also depends on the availability and the demand for insurance across the world. In some societies where the people are more insurance aware, you do have more insurance footprint. But you also have to consider socioeconomic pressures, whereby if you have a population that just barely earns enough money to survive, they're not going to consider insurance a priority, so they won't spend money on insurance. The example that comes to mind is Haiti and the earthquake. You must remember a few years ago, when you looked at the pictures on the news report, it was a horrible human disaster. However, only 1% of the losses were actually insured. So as regards insurance, it was a non-event. We all know that the most sophisticated insurance markets are to be found in Europe, North America, Australia, New Zealand, and Japan. But as insurance markets develop in Latin America, Asia, and Africa, these countries will grow their own financial and technical know-how, and the pattern of the insured losses will actually change over time. As we know, losses from natural catastrophe are usually large and predictable. When the event takes place, the extent of the physical damage suffered is what determines the total economic loss. Of the total economic loss, there's a percentage which is usually uninsured. A proportion of what is insured will be carried by the global insurance markets, but the public sector, as in the state, usually insures the infrastructure in the country. And in some cases, they do so with the reinsurers through a public-private partnership, which transfers a proportion of the risk to the insurance market. Examples can be found in places like Italy, where there is a state-run earthquake fund. Turkey also has a similar state-run earthquake fund. A more sophisticated example exists in Mexico, where they've got a federal catastrophe program, which is called the Fonden, and that works very well. Insurance claims, of course, will affect the primary insurers first. These companies only absorb some of the losses, as they usually cede or transfer their share of liabilities to reinsurance companies. From statistics, we deduce it's around 60 to 65% of the losses are transferred to reinsurers following a catastrophe. The reinsurers then share the risks among themselves, and they also pass a percentage of other elements in the financial markets, though ultimately the greater part of the catastrophe risk is retained within the reinsurance market, which is the large bit at the bottom. The business model, you can see, is quite simple. Primary insurers enter into contracts which create a vertical link with reinsurers. In addition to that, the reinsurers transferring risk to one another form a horizontal link amongst themselves. Statistically, about 15% of the nat cat risks is retained within the reinsurance industry. However, reinsurers also want to protect themselves, and failures of reinsurance companies are not impossible. So if your loss ratios constantly exceed your loss reserves, you can be in trouble. So how does a reinsurer protect himself? Well, you create links with financial markets and you transfer the risk out of the insurance section. This is called retrocession. And it uses similar contractual arrangements with those that exist between reinsurers. It commits banks and other financial institutions to pay out if the retroceded risk actually materializes. There's also securitization, which issues insurance liabilities to a wider financial market, such as other financial institutions like hedge funds, banks, pension funds, and mutual funds. Among the insurance-linked securities, catastrophe bonds are the main instrument for transferring reinsured disaster risks. I'm sure you've seen quite a few articles in the insurance press when they talk about the cat bonds in the US and in Bermuda. But of course, explaining cat bonds is a complete subject in itself, and I'm not going to talk about that here. So, when we look at loss payments, as I say, typical thing, reinsurance industry, our main focus in this particular type of event is to deal with the actual natural catastrophe. The events that usually are thought of as a natural catastrophe tend to be earthquakes, hurricanes, cyclones. However, over the past few decades, there's been an increase in events like floods and wildfires, and they've added to the impact on insurance. Catastrophe events were unusual events. They occurred in different geographical locations and at different times. It allowed reinsurers to prepare for this peak event by accumulating premiums over several years. So when the event actually happened, they had money in place to meet the demands on their liabilities. Statistics show that the average payouts on a Cat XL contract take place over an extended period of time. The source of the information we have here is from the Reinsurance Association of America. It costs a thing called the ICIS database on insurance companies worldwide. So on average, about 60% of the losses are paid within the first year. By the end of the second year, you get a further 20% losses paid, so you've got about 80% of your exposure has been met. The remaining 20% of claims tend to be the complicated claims, the ones where you have coverage issues, the ones where you also have quantification problems, or you probably just have difficulties with the insured and end up in litigation. And the average statistic is it takes about 5 years in total to finish paying every single claim resulting from a CAT event. But of course, that depends on the territories and on the legal system in certain places. Sometimes the events can drag on. I do know of a catastrophe insurance claim which lasted for 17 years through the courts. This was in the USA. But it's finally finished, so I believe. Anyway, as regards to insurance, we've got two types of reinsurance: facultative reinsurance and treaty reinsurance. Now, the facultative is for individual risks. The right insurer chooses the individual risks he wants to offer to the reinsurer of his choice. This may be due to the high value of the actual risk. The sums insured can be very, very high, or because they may need a special acceptance because of the type of business that the risk involves, or the location of the risk, or even the risk may actually fall outside any standard definition, and it requires special cover to be assessed for this particular risk. Treaty reinsurance is for the entire portfolio of risk. So the insurer uses this to protect their exposure on books of business like motor, property, marine, energy and engineering. This is particularly necessary when there's a possibility of high volume of claims from a natural catastrophe event, or simply through accumulation of losses on a particular portfolio. Motor portfolios tend to be typical for this thing. Now, there are two types of treaty reinsurance contracts in use which determine the way primary insurers and their reinsurers calculate a premium that's to be exchanged and determine the limits of liabilities in the contracts. You've got your proportional reinsurance contracts, which share the premiums and losses on a predetermined ratio, and it looks like a tower, as you can see. The sharing of the premium and the losses goes all the way up from the ground up, the loss, right up to the limits. Your non-proportional reinsurers contract is different. It doesn't share the premium or the claims on a fixed proportion, but instead both parties agree on the insured risks, and they calculate a specific premium based on that basis. Typically, the non-proportional contract specifies an amount beyond which the reinsurer assumes the losses. We call it an attachment point or a deductible. And then you have an agreed limit, which can be, let's say, the limit of the first layer, so your layer 1 limit. The primary insurer may have a higher exposure on a particular risk, so there is the option to buy additional layers of reinsurance cover. They can use the limit of the underlying layer as the attachment point for the next layer. Reinsurers on each layer can vary depending on the commercial appetite of the company. You have excessive loss agreements, which is the most common non-proportional reinsurance cover. As regards catastrophe cover, they're denominated CAT-XL, and their cover extends from the primary insurer's retention for a single event. For example, if the event is a large flood, the primary insurer is likely to be hit across its entire portfolio, resulting in thousands of claims across many lines of business, such as household, motor, commercial, property, business interruption as well, and many others. This type of event is what makes a primary insurers buy CAT-XL to protect themselves against a peak event. We've got a stop loss, which is an agreement that covers total losses over a given period. In effect, it covers the accumulation from multiple events. Your aggregate XL protects against an aggregate amount of losses in excess of a specified amount, and your normal risk XL, which protects against a large individual loss. Now, we've gone through the insurance industry relationships and the type of contracts that are available. We can focus on the management of a loss portfolio from the perspective of the reinsurers. We can do this using a number of examples. As we're in Russia, I decided to pick a couple of examples which will match the disaster risk profile for Russia. As we know, Russia is the largest country in the world in terms of surface area. And according to the disaster risk profile, Russia is prone to the following natural events which can develop into catastrophes. You've got an earthquake, the example is Sakhalin in 1995. You've got floods. They had major floods in Siberia in 1998, 2001, also in 2013, and now again in 2019, earlier this year, they were on the news. Wildfires. In mid-July 2016, over northern Siberia, there were satellite pictures that spotted extensive fires. And again, July, August this year, you've also had big fires in Siberia. They were once again in the news. I've chosen a couple of recent examples which I've dealt with in SCORE. One is a wildfire that grew into catastrophe disaster in South Africa in 2017, and the other one is floods in Kuwait in 2018. So let's talk about reinsurance action. From the perspective of SCORE, Treaty Claims Department, we keep up with news stories, case law and changes and any legislation that may affect claims resolution in different territories. When we spot a news story that has the potential to develop into a catastrophe, whether it's a notification of a storm or extreme drought, we start looking at it and start analysing the potential impact on our book of business. As claims manager, I discuss the matter with the relevant underwriter, and depending on the developing event, I discuss it also with our CAT modelling team, and also contact the actuaries and start gathering information on potential exposure of any contracts we have in the particular region. The information obtained from the underwriters and the actuaries will help me to identify which contracts are likely to be hit, and therefore it enables the underwriter to contact the clients. Once a catastrophe has hit a region, we contact the local insurers and inquire about the impact that the event has had upon them. We also offer support and assistance. This can be in terms of recommendation of adjusters and experts, technical assistance on complex claims that fall into our treaties. Also, an important thing is to remind the local insurer that they're not alone. Out behind them, you have a reinsurer who is ready to help them. As you can imagine, as soon as disaster strikes, it's impossible to quantify an extent of damage until someone has been out onto the site and see what's happened. For that, as reinsurers, we depend on the insurers and also on the loss adjusters. In an ideal world, we would be allowed to wait for the correct information to filter back to us, supported by loss reports and solid data. However, that's not the case. Usually, within hours of a disaster occurring, we're asked to produce an estimation of losses to the book of business. The request usually comes from top management. To do that, as a claims manager, I have to gather as much background information as possible, understand what the insurers have put on their portfolios to reinsure, and also what limits they actually have on our contracts. The estimation of the losses, in effect the quantification, I carry out by reviewing the data from public sources, assess the extent of damage in an area affected, and then I apply my own experience as a loss adjuster to work out an average loss amount. This can be done with a certain degree of accuracy if the insurers provide you with some data from their own risk modelling. However, not every insurance company has a risk modelling department, and they don't actually use this process. But from that initial estimation, which is discussed with the underwriters, as their input is very important because they have local knowledge of the local market conditions, we use that to calculate 3 potential exposures in which the company can actually make risk-based reserves. You have a best case scenario, you have a worst case scenario, and a average case scenario, more something which is more close to reality. For the worst case scenario, we usually use policy limits as the calculation parameters. The estimation is determined using the contract wordings, and we look at the coverage provided. This is discussed with the underwriters, of course, the actuaries, and in some cases with our own internal legal counsel. Once we have a clear position, it is outlined to the broker or to the insurer directly, as soon as it's possible, so that if there are any disagreements, they can be put on the table and discussed quickly. As you can imagine, disagreements on coverage have to be solved very quickly, because cash flow can be a big problem for primary insurers during a catastrophe event. For a larger insurer, a cat event in a region will impact a number of clients that operate there. In the examples that I will talk about later, in the fires in South Africa, there were 8 insurance companies that were affected, and SCOR had treaties with all of them. Some of them had proportional treaties only, some of them had proportional and non-proportional treaties. And in some cases, several types of contract were affected. So you had property contract, engineering, motor contract, and also a Cat XL contract. This gave rise to an accumulation of losses. And in some cases, like large individual risks, which were insured locally by several primary insurers on a subscription basis, this found its way onto each of the treaties with SCOR. And in the end, our share of the individual loss was larger than the one held by the primary insurer. This has occurred to me in the past, and it's a market meeting, and it's actually helped SCOR have a larger voice in the discussions of strategy, because we had more money on the table than anybody else. We monitor the accumulation of losses by using an event code in our system. It's an internal way of keeping track of it all. In this way, we can generate a report for the company to give you the idea of the company-wide exposure for the event. We can use this system to generate a large loss notice, which is used to inform senior management of what is actually taking place. For the actual handling of the claims presented to us by the insurers, we have to proceed in a special manner. First, we've got to make sure that the loss occurrence definition in the policy matches the actual event. The coverage in place, both the treaty wording and also the original policy, has to be reviewed. Definition of the perils covered, as well as the hours clause and also distance clause, are applicable to the analysis. There are times where discrepancies in coverage become apparent, and these can raise concerns of potential disputes. It's important to always keep in contact with the insurers and highlight any possible problems quickly. So as I mentioned, you can solve them and try and stop it impacting the cash flow. As regards the claims themselves, the contract will specify if it's a claims control or claims cooperation. Either one allows the participation of the reinsurer in the handling of the claim, though the first gives the reinsurer overall control of the strategy, as well as the appointment of experts and the negotiation of the settlement. Nowadays, it's very rare to find the claims control clause in contracts. The more common one is the claims cooperation. In this case, claims cooperation, the primary insurer retains the control of the handling of the claim, but they share information and discuss the strategy and adjustment process with the reinsurer. There have been cases where SCOR, as a reinsurer, we've appointed our own loss adjuster to go and assist the locally appointed adjuster to actually deal with the claim. The determining factor for that is usually the loss location and also the nature of the claim. In certain countries, a large complex loss, which can have a biggest interruption cover, may be beyond the capabilities of a local adjuster to deal with. The idea of sending our own expert is not to take away the case from the local adjuster, but to help him, provide him support, and hopefully teach him how to look at the claim from the reinsurance point of view. This support also provides confidence to the reinsurers and also in insurers. The insurers realize that the reinsurer is there to help them, and with a little bit of luck, if the local adjuster is clever and he learns from the foreign expert that's been sent there, by the next event, he will have actually improved his reporting system and he will have actually learned, and there will be no need to send anybody else there to help him. As a result of using our own expert, when the insurer presents a cash call, we can be sure that the amount requested is correct. This helps process the matter quickly, prevents insurers from having cash flow problems given the large number of claims they have to settle at short notice. Internally, as SCOR, we keep constant monitoring of all cash calls, especially at the end of the quarter. All reserves have to be reviewed and to ensure accuracy and consistency across the board. Communication with the underwriter is always important, especially at the time of cash calls. We review all the reserves, and when we don't have information, we actually set up a thing called an additional claims reserve, which is called an ACR. And we actually do that at the time, particularly before quarter end period, when we actually have to have some numbers on the systems. Another thing, of course, that we discuss and we always ask the insurers to advise us is on the IBNR. Is it incurred but not reported claims? This is the amount owed by the insurer to all the valid claimants that they have on their portfolio. But they may not have received the claims from these people yet, but they can make an estimate of how much they're likely to pay on each one of these. Over time, this number, this IBNR, is reduced. So eventually, by the end of the lifetime of the claims, you will actually reduce the IBNR to zero because you will have had all the valid claims and processed them all. Your ultimate net loss amount includes all the loss adjusting expenses against which you actually apply retention and limits. As I mentioned, I'll talk quickly through a couple of claims that I dealt with, which matched the disaster profile for Russia. One was in Nisa in South Africa. It was in June 2017. You can see from there the bullet points here. It was a storm that came in on the Cape, and apart from heavy rainfall in the Cape area, they had very strong winds. And the very strong winds caused small wildfires, which were in the Nisa area, which you can see on the map there a little bit away, to actually grow into much bigger blazes, and then they joined together and they created a gigantic blaze, which burned a very, very large extent of the area. There were a number of problems as regards that. The market, of course, when they were looking at the loss, they thought, well, is it storm, is it fire, is it two events? You had issues concerning hours clause. Also, there was a geographical limitation element to it. The actual amount of loss, as reported by the South African state, was about 4 billion South African rands, which is about 276 million euros. So it's quite a lot of money. Now, the actual details, bullet points of it. As you can see, the main element was the argument whether it was two events or one event. There were some insurers were insisting it was going to be two events. However, there was a great deal of analysis of the actual wording and also study of the meteorological data, and also legal advice was sought. And the main cause was the approximate cause of the fires, which caused the majority of the losses. About 95% of the losses were from fire, only 5% was storm. The actual approximate cause was found to be the wind. If you didn't have the wind from the storm, the small fires would have just burnt themselves out, or they would have been put out by the fire brigade. But the wind made the fires grow and join in with other small fires, and it became uncontrollable. So the actual cause of the massive blaze that destroyed all these properties was the actual storm. So it was agreed to be classed as one event. Another issue was the actual hours clause. The policies specified the loss had to happen within 168 consecutive hours. Fortunately for the insurers and also the insured, the losses did take place over a few days within the 168-hour period. Now, the actual policy there also had a geographical area. The losses had to be within 80-kilometer radius. So we calculated the actual distances, and we actually found out that the losses fell within this actual 80-kilometer radius. So it was actually able to be dealt with as a single event. If the losses had been beyond that, then you would have actually had a chance of splitting it into two, because it would be two geographical areas. So it would have actually allowed you to have two events, despite the fact that the cause, the wind, was the main starter. Then the other example that we have is Kuwait. I'm sure you probably saw in the news last year, in November time. They had 4 periods of heavy rainfall in Kuwait. The average rain there is 19 millimeters in the month of November, and they had three of those periods where exactly around that size of rainfall, but one of them was 117 millimeters. You can imagine the amount of water falling so quickly. It's a desert area, yes, but the ground got saturated very quickly after the first downpour. So when the second, third, and fourth happened, it just flooded everything. And you can see it from the pictures in the news. You don't expect to see that in the Middle East in the desert. Than riding a boat in the middle of the town. Now the key problem here is when you've got 4 separate time periods, you've also once again got hours clauses. You've got also geographical locations on the policies. Fortunately, in this case, you didn't have any geographical limitations. But you did have the hours clauses. You have, in standard contracts, you will have things like 72-hour clauses, or for certain accumulations, 168 hours. One key thing on the reinsurance treaty is that the start of the event from the meteorological data doesn't necessarily mean that's the start of your insured event. The actual the insurer can choose the start moment, the start day and start time when he wants his reinsurance to kick in. So an example of a timeline. So if we've got between day 1 and day 20, the event starts on day 4, ends in day 17. If you're an insurer and you have 168 hours, and your biggest losses were actually affected between the 10th and the 16th, you actually want those to fall into your catastrophe program. So you will actually start your start date, your start moment of cover on the 10th. Chances are that this insurer also has losses from the 4th to the 10th, but those losses will probably are smaller by comparison, maybe the household, motor things. That would probably fall within the 15% of losses that the insurer will actually retain, and he doesn't actually need the reinsurer's support to deal with those things. Usually an insurer will choose the biggest risks and make sure that the time actually will cover that. Of course, a big risk means, of course, big payout in the end, and for that they always rely on reinsurers. Just two examples of clauses, an excess of loss clause and a quota share clause. You've got the definition of loss occurrence. They're very similar case. You have more, it's a bit fuzzy, sorry. You have the hours definitions there. Those usually change slightly. So you've got 72 hours consecutive, then the 168 consecutive accumulation. And then on the other side for the quota share, you've got differences. You've got 24, 72, 504 hours. All depends as per contractual wording. And then at the bottom, you can actually see it, both of them actually say, the reinsured may choose the date and time when any such period of consecutive hours commences, provided the period commences earlier than the date or the time of the happening. So you see, it allows some flexibility to make sure that the biggest risks fall for cover within the reinsurance contracts. Say just a couple of simple catch-up points. So, how does the event subject to the hours clause and the limitations? Is it the length of rainfall, the water rise period, flood duration? What's the right definition for the date of loss? So of course, as I say, we don't set, as reinsurers, we don't set the start date. That's chosen by the insured. The meteorological data is used to determine the start and the end of the period of the weather event. The cedent then chooses the time they want covered inside that time. The start of the event, of course, has to be logical. You can't actually, if the meteorological event starts on the 4th of the month, you can't have claims that started on the 3rd. And of course, the hours clause starts running from the moment that the insurer decides it's the start moment. As regards geographical limitation, I'll say some treaties specify the area as well as time for a specific event. In the case of South Africa, it's stated an 80-kilometre radius for the fire event. It's not unusual to limit the extent of flood damage areas. I've actually seen sometimes you have extent of flood is described as being a city centre or a certain kilometres around a particular habitable location. I say the policy doesn't specify it, but you can actually always use the political area on a map as a way to actually consider the geographical extension. The policy, if it does specify a radius, you just have to discuss that with the insurer. You see, the central point of where you will start calculating your distance is something that has to be agreed with the insurer. Of course, the insurer will want to include as many claims as possible in that geographical area. And that is just something that you discuss it with them, you choose the point, and then you draw your geographical extent from that particular point. Of course, key thing to do when you're dealing with the claims, bottom bit, always check the data which the client sent to you as an insurer. The bordereaux should have all the dates of loss within the agreed period of time, and also the location and the type of losses should be correct as well. Individual large losses should be monitored apart. If the quantum justifies it, we consider sending our own adjuster and our expert to assist the client's expert in that particular case. So, in conclusion, from the reinsurance point of view, we always have to be aware of potential natural catastrophes and how they may develop. Close communication with our own colleagues is imperative. Underwriters, actuaries, CAT modelling team Also, communication with the clients is very, very important to offer them support and assistance, as I said earlier, so that they know that they're not alone, that there's somebody out there that will actually help them and support them. Be aware of policy coverage, both original and reinsurance. Check the information provided matches what you're actually expecting, date of loss, locations, all those things. Create an initial loss range with expectation of best, worst case scenarios. Work towards achieving accuracy in the shortest possible time. And that is done by information which the insurers provide us and information which they get from the loss adjusters out in the field. And that's the end of that. If you have any questions, if you have time for questions, catch me later.
Коллеги, пожалуйста, если вы будете задавать вопросы, делайте это в микрофон, чтобы переводчикам было удобно переводить без искажений. Со своей стороны могу сказать, что мы прослушали очень интересное выступление. Как мы слышали из выступления Антонины, природные катастрофы занимают 3-е место в мире по своему размеру, но для России в связи с не таким глобальным распространением пока страхования киберрисков и бизнес-интеррапшн, скорее всего, природные катастрофы могут занимать 1-е место. Особенно с учетом того, что вступил в силу закон о страховании жилья, поэтому со временем я уверен, что этот риск будет наиболее востребован у наших страхователей. У меня есть собственный вопрос к Рональду, но, пожалуйста, вы со своей стороны задавайте, потому что тема очень интересная.
Okay. You mentioned briefly that the claims cooperation clause tends to be more frequently used compared with claims control clause. And what are the consequences for the assured? Disadvantages, advantages? Because the claims control appears to be more straightforward in terms of decision making and further actions then.
Yes, you're right. Claims control does allow the reinsurer to control the strategy of the claim and to also negotiate the settlement. But when you think reinsurer may be the other side of the globe, you have an insured, let's say he's in Kazakhstan, insured by a local Kazakhstan company, and then there may be socioeconomic issues which the local insurer understands and the local insured understands. And if using claims control, the reinsurer, whether in Germany or in London, they send somebody from there to adjust the claim and to deal with it. It may be somebody who doesn't understand the local problems that are being faced and may try to impose a different kind of strategy to solve the actual business interruption loss or mitigate the loss, which may not actually fit in with the problems in the country. Whereas by using claims control, I find it's useful because you have the local knowledge of the local insurer and the local adjuster who understand what's happening there. You can send somebody from London or Germany to help the local adjuster, but he's there to assist, not to impose his way of doing things on the local man. And that's in a way why you usually find claims cooperation is more popular with insurers around the globe, because it allows them to keep more control and also provide more support to their insureds without simply saying, it's out of my hands, it's the foreign reinsurer is sending a foreign man here to come and tell you how to do your business. A lot of it is also, as I say, psychological.
Так, пожалуйста, микрофон передайте, пожалуйста.
Ronald, could you give us some examples of NatCat claims handling in which you were involved in the Russian Federation, if possible? Not so huge as in Africa, maybe, but in Russia.
Yeah, well, the NatCat is something that's quite new in Russia as a product. I haven't actually seen any catastrophe excess of loss claims appearing in the West so far. So as regards Russia, I didn't have an example to show. That's why I had to use the South African and the Kuwaiti example, because they fit the disaster risk profile for Russia. As I was mentioning, as the market in Russia develops and becomes more sophisticated, there would be more of an appetite from the public to buy more insurance. And therefore, as insurers, you will be open to more risk, and that's when a Cat XL program will be very useful for you to protect yourselves. And then, yes, if you remember the news reports, the floods in Siberia in July, August, imagine if it was on your book, let's say 2 or 3 of the towns that were completely wiped out. Imagine if you had all the insurance policies for all those people in your books. That would be financial, very difficult. That's why you would need your Cat XL program that would come in and help you. So at the end of the day, you probably retain, I don't know, let's say 5%, and the other 95%, the reinsurers will actually bring the money to help the people in the end.
Еще вопрос, коллеги? Если нет, тогда у меня со своей стороны вопрос. Ronald, we saw in your presentation that about 60% of sums is settled by the reinsurance within the first 1 year. My question is regarding cash calls. How would usual scenarios that the reinsurers, when they estimate, for example, middle level of value of total claims, how often they provide not just support and the recommendations of loss adjusters and how to do with the claims, how often they provide real financial support. I mean, how often they do cash call payments, advance payments, how can I say?
Yeah, the cash call, it depends what the contract says.
Of course.
Usually, of course, you've got your standard quarter-end payments, which are the normal treaty statements. But for catastrophes, of course, it's different. So once the insurer collects a certain amount of losses in which they have to pay, they will send that through as a cash call. It may be, let's say, they've settled 500 claims, so the accumulation of that is sent through as a cash call. Usually the borderer will have sufficient data to allow you to see what it's all about. The processing of that's quite quick, quite easy. Large losses are usually identified at the beginning of the process when you get the reserve notifications, so you can actually take them out and follow those individually. So let's say if you have a power generation plant that's affected, and when that loss gets settled or there's an advance payment request comes through, that's a separate cash call on its own. And for that, usually you ask the insurer to send you some information from the loss adjuster. And in those cases, it's usually contractually stated in the treaty, you have to support them for the individual cash losses, the individual cash calls. The information required is not as detailed as you would require as an insurer. It's more high level. But usually for a large payment, an adjuster report is very welcome because it helps you understand what's actually going on. So having been an adjuster myself, usually is people that I know, old friends of mine who are doing these big losses. So as being old friends, I can pick up the phone and call them, have a quick chat about what they're seeing there. They can give me the information of how the loss is going and progressing, and it helps process things quicker.
Thank you very much. Thank you, Ronald.
Thank you.